Well, good afternoon and welcome to HYROX's weekly webinar where we are going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. Well, I'm Scott Tomlinson, and my partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, today, as the year 2016 draws to a close, we are going to strictly focus on the outlook for 2017 and outline our themes for next year. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. To a large degree, bond markets have been showing this to us already. Higher bond yields and higher short-term rates in the U.S. with tomorrow's Fed rate increase will increase the costs of borrowing, which in turn could present us with a whole new set of risks with global debt levels at record highs. With improving economic conditions and a lower tax burden, it is expected that earnings will grow at an approximate rate of 11.5% in 2017. It is expected that as energy prices recover, this may be one sector to lead the earnings resurgence. And it remains to be seen how the new populist revolution plays itself out. But first Brexit, then followed by Trump, and now Italy, and soon there will be elections in the Netherlands, France, and Germany, and there is very real potential problems for the euro. And the U.S. appears also to be moving its alignment away from China and somewhat closer to Russia. Well, in their global outlook for 2017, BlackRock Investment Institute iterated a theme that we have been promoting since the inception of our private client division in April 2015, that the old rules for diversification were no longer working and that long-held relationships between asset classes were breaking down. And this was a paramount theme in our development of a tactical investing model to complement our fixed income and global equity models. The three models that we use to get balance in our portfolios also allow us to have greater flexibility and depth over the standard buy and hold strategies, and this will be even more important as we structure our investing process for 2017. There have been a few opportunities to buy market weakness in the past few years. We are cognizant of these and how they develop, and we're very busy in early 2016 participating in some tactical situations to enhance portfolio growth, and we'll be looking for more in the coming year, recognizing that being tactical and flexible allows us to protect our clients' capital and capture asset value at the best possible times. We have a great deal of expertise and experience in doing this, and our goal is to always provide our clients and ourselves with the best possible risk-adjusted returns. Over the course of 2016, the return on our balanced 60-40 portfolio with a combination of our three models is well ahead of the comparative benchmark this year to date, with 2 weeks left in the year. The benchmark consists of the total return on a daily basis of a fully invested buy and hold strategy of 60% of the All-Country World Index ETF and 40% of the Canadian Bond Index ETF. Both numbers are after fees and other NER costs. As well, I am required to remind you that past performance is in no way a guarantee of future performance, but as you all know, at High Rock, we work darn hard to get the best possible risk-adjusted returns for our clients and for ourselves as well. Well, inflation-adjusted bonds have jumped in price, which indicates that years of central bank monetary stimulus and the promised fiscal stimulus from the new administration in the U.S. are combining to build investor expectations that economic growth and inflation may finally be returning. Commodity prices are rising, led by oil, on the back of the output agreement between OPEC and non-OPEC countries. And as I mentioned earlier, central banks have bought trillions of dollars of assets over the past 8 years in an effort to stimulate growth and inflation. But as we have learned, it takes more than just monetary stimulus. It takes a combination of that liquidity, government spending, and more importantly, reduced taxes as incentive to get corporations to attain the level of confidence that they need to ramp up investment in future productivity, which has been significantly lacking in recent years. And this has certainly been instrumental in creating the latest stock market rally. Now, consumers are confident too, and that is also a direct response to the U.S.'s apparent turn in political direction. Now, we do have to be on our toes, however, because historically, following peaks in consumer confidence, recessions have followed. So, of course, we'll be monitoring that. And this does tie into our theory on unemployment and recessions. If employment should jump and consumer confidence turns, if unemployment should jump and consumer confidence turns lower, perhaps on some disappointment that the reality of the new administration is not what the consumer felt was promised, in which case we may need to make some strategic adjustments to our investment allocations and reposition our portfolios. But we have the ability to act quickly and simultaneously for all of our clients if that should in fact become the case. Well, bond yields are rising as bond investors are now expecting more inflation and want higher yields for protection. That forces other borrowing costs higher, and tomorrow the U.S. Federal Reserve will likely raise interest rates by 0.25%. More importantly, the Fed will let us know what their revised expectations for further rate hikes will be. Given the change in inflation expectations and almost full employment, they may want to speed up their desire to normalize interest rates. Another reason for us to take a more tactical approach to portfolio management. Well, higher borrowing costs will make servicing the record amounts of global debt more expensive. The proposed U.S. budget deficit will certainly add to this, but it is hoped that better economic growth down the road will allow for this debt burden to be manageable. Something else that we will want to be paying attention to, because if that economic growth does not materialize, we are going to want to be more flexible and tactical. Well, investors are confident too, because clearly stock markets have built in a robust 2017, even with earnings already estimated to grow about 11.5% next year. The 12-month forward-looking price to earnings ratio is at its highs at about 17.1 times, well above the 10-year average of 14.4 times. But we will not be so inclined to be buying the expensive S&P 500, for example, unless there is a dramatic repricing and because of the huge expectations for a rebound in energy earnings. But using our tactical approach, looking for value in each of the individual economic sectors to avoid buying any that we think might be expensive. Sectors like healthcare and information technology look reasonable at the moment relative to their longer-term average to price earnings ratios. And finally, the wild card, geopolitics and trade protectionism. What happens with Brexit? How does the new U.S. administration align itself with China and Russia? What happens to the euro? Will it survive elections in the Netherlands, France, and Germany? And what happens next in Italy? We do know that populism is on the rise because the middle class in developing countries has felt left behind in the race toward globalization, and the backlash has only just begun. Lots of pending questions, and we will have to wait for some of those answers. And this certainly leads to a great deal of potential uncertainty, requiring an even more flexible and tactical readiness. So there you have it. Those are our themes for 2017, and we feel ready and prepared to bring our clients the best possible risk-adjusted returns that they have become used to. Paul, your turn if you'd like to add anything here.
Hi, Scott. Can you hear me?
Yeah.
Excellent. That was a great presentation. I don't have a lot to add. Of course, you and I have discussed these themes at length, but I would just add to our listeners, clients and listeners, that within the tactical side, we will continue to do our work, and which is largely research-driven, and constantly look for opportunities that will add value to our portfolios and create stronger risk-adjusted returns. And just by way of example, today at around 1:30, our largest position is in a chemical company, Canexus. And Canexus was put in play October 3rd by another chemical company, Chemtrade, looking to acquire it. But today they came out with the higher bid for Canexus at $1.65 versus $1.45. But we're not going to make that much money on the stock, but we own bigger weights in the senior unsecured bond of Canexus and a convertible bond of Canexus as well. That's really where we're going to make a bit more money here. I noticed they were priced up higher this afternoon. So just an example of the type of work we're doing across the entire capital structure of a company, be it the bond, corporate bond, or the stock of a company, and the impactfulness it can have on our portfolios. That's it.
Excellent. Thank you, Paul. That's great, and it's great news, too. All right. Well, as always, we want to thank anybody who's listening for taking the busy time from your schedules to tune in. This will be our last webinar of the year, but don't forget to tune back in on January the 3rd for our first webinar of the new year. But until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all the very best of the holiday season and a happy, healthy, and prosperous new year.